Hey, look, it's 60% off. This is to start. You should be willing to pay a premium for the company. That's the big key with 52-week lows. They're very, very close. 52-week lows are some of the best places to start looking for value plays. Just because a stock is at a 52-week low does not mean it's a value play. Right, Mo?
Correct.
The example I always give, if you just go based on price change, let's say you have a house that's worth $500,000. You decide, I'm going to ask $5 million for it. It's worth $500,000. The entire neighborhood's $500,000. They're all cookie cutter homes. I'm going to ask $5 million. It's going to sit there and do nothing. Wait a second. I'm going to give everybody the deal. I'm going to lower the price to $2 million. Hey, look, it's 60% off.
Screaming deal.
Does that make it a screaming deal? No.
Not at all.
However, 52-week lows are a great place to start because it shows you that something has either changed in the company or the perception of the company. There are three major companies right now that we get, well, there's tons of them, but Apple, Google, are they close to 52-week low? Mm-hmm. Four companies, Apple, Google, Tesla, and Amazon are all at 52-week lows.
Yeah, I mean, we're $5 away from 52-week low.
So they're very, very close. Yeah. But what's the next step? Once you have found a company I think 52-week lows are a great place to start, but the work just starts at that point. What's the work? Now you got to value the company. You got to sit there and use the software to determine what your price. Now I'm going to go to Google here. It's a very simple company with a very simple balance sheet to understand. We have our 8 pillars here. According to this, we still have a lack of value. But remember, if a company has an ability to grow its earnings and or revenue at a faster pace, you should be willing to pay a premium for the company.
I'm looking at these two things right here. These two return on invested capital over 1 year and 5 years.
This is how companies compound their earnings over long periods of time. The market's going to do an average of 10% per year, give or take. Our metric is we want 9% over a 5-year period. But the big key here is these higher numbers and a higher growth revenue number coupled with this can really justify a much higher value. That's the big key with 52-week lows. You got to sit there and take that low price and say, okay, what is this company worth? And once you've determined its worth, which a lot of people use our stock analyzer tool for, this doesn't factor in the balance sheet. But let's say, for example, I want to do a 10-year analysis on Google. And I'm going to be basic here. I'm just going to call it 4, 7, and 10% revenue growth. Profit margin, 21, 22.5, and 24. Let's say some of their other bets work out. I'm going to do the same thing with free cash flow. So I'm basically just making my assumptions about the future. I want low. That's kind of like, listen, it's probably going to be this all day. Middle, which is like, okay, they do a little bit better. High, which is like, hey, they really crush it. Actually, you know what? For the profit margin, I'm going to go 20. No, they're going to cut costs though. I'll go to 20. That's fine. Oop, that's 10. PE. Now here's the question. The current PE is 17. The current price of free cash flow is 18. Now they have a 5-year number that's much higher, but remember that 5-year number should be higher because they were really growing their earnings per share and their net bottom line profit. So Mo, you give me what PE and price of free cash flow, knowing that they're growing and they're high return on invested capital. And I guarantee Mo and I will disagree.
15, 17, 19.
Praise the Lord Jesus Christ, my Savior above. I think we agree.
Really?
I was going to do 15, 17 and a half, and 20.
I almost went 20. I was going to do 16, 18, 20.
Oh, see, I'm still going to stick with 15 because I still want to be low. What desired return do you want, Mo?
12, 14, and 16.
Fine by me. I think you can justify lower.
Yeah, I can go lower. I can go 12 across.
Analyze button, boom. So here, on the high side, we have $100 a share. Yeah. And guys, we've done this video so many times with Google, and we come up with numbers all over the place. The point is, right now, based on what I'm seeing here, Google's not too bad.
It pretty much comes to the consensus every time that 80 is probably that solid middle number.
And I have my watch list at 85.
There you go.
Now,
and that's to sell puts, not start buying.
Correct. I will tell you though,
I might start buying that.
Yeah, but the only reason I'm not, and this is me literally trying to not time things, but kind of time things.
Market thesis.
I think the market is just so overpriced that when these stocks fall, this will fall along with it. Yeah, and I have so many different sources of revenue and profit and cash flow that I can be more picky on when I buy stocks. I also do options. So I can sit on a lot of cash and still make 8 to 10% a year doing my options. So I don't have to rush to buy things. Now, with that said, Southwest Airlines is down 6% today. Once we leave the studio here, I'm probably and you shouldn't follow my lead. Do not follow my lead. Do your own research. This is not for you to do it. I'm going to put an order in because you don't know how much I'm going to order of Southwest. Spoiler alert, it's going to be such a small amount that people will probably say, why'd you even order it? But the point is, I want to take advantage of a nice drop in the market. And do I think Southwest will probably go lower? I could see Southwest of all the companies, maybe not, but it probably will. I bought Southwest at 25 in the COVID crash, and it literally went straight up to 50 from there. And I got them taken away on covered calls at 47.
Here's an example of a company that has dropped 50%, is at nearly 52-week lows, and we're not interested in buying this at all, like Google. And it's Amazon. Because I look at this and say, $85 a share, call it for purposes of this video. We were talking about it the other day, and we said, is 50 even cheap? Based on all of these 8 pillars, based on all of their financials, is $50 a good price to pay here? We couldn't determine if it was or not.
So that's when we can't determine it, what do we say?
Move on.
Pass, move on.
And yeah, I know, it's Amazon. We get it. They do everything. But for them to do $150 billion in revenue during a holiday quarter and break even?
That was their goal. Let's do $150 billion in revenue and break even. I look at it going,
$150 billion.
I don't get it. And for me, that caused me to say, I'm out.
Yeah.
Look at that gross margin, 13%. Guys, Walmart has a 25% gross margin.
Yeah.
Something like that. It's just hard. And people are sitting there saying, well, AWS is still growing. Yeah, but AWS has a lot more competition. It's a high margin business.
But the thing is, if AWS keeps growing and just carries the business and they don't make money because they're spending so crazy in other parts, then we're at a standstill forever.
I
can
agree.
Get bigger and bigger, but we're not going anywhere with our investment.
So for us, it just doesn't make sense to us. So we don't. And what's the all-time high? 188?
Yeah, 188.
July 13th of 2021. That was 18 months ago.
Yeah, they did a big split.
17 months ago.
What are they, 21 split or something?
20 to 1, yeah. So it was essentially the high was like 3,700.
Yeah.
And now it's at 1,700 split adjusted.
Yeah.
So guys, 52-week lows, we just showed you 2 companies, one of which we started, hey, listen, I wouldn't blame anybody. I would look at going, if somebody said to me, Google's obviously overpriced right now, I'd say, no, I don't think so. Like, I don't look at Google going, oh, get the F out of here. I look at going, okay.
And the other thing about 52-week lows, and Tesla's a good example of this right now, every time this hits a new 52-week low, people get more bearish on it. And the selling just continues. Look at this. We started this video, this was down 6%. We started recording today, it was down 6%. Now it's down 7%. And this just keeps falling and falling and falling. In the past month, 1 month alone, it's down 32.5% because there's just so much negativity. So that's how you could take advantage of looking at 52-week lows and say, hey, I'm going to pay attention to this thing. There's a lot of negativity out there. I want this thing to go down to like $50. It doesn't look so stupid anymore. It doesn't look as stupid as it did a month ago.
Yeah, so let me do this. I'm going to pull up our last analysis of Tesla. I did a 20-year analysis, 5, 12. No, I got to adjust this. So 5, 9, and 13% revenue growth. Profit margin, let's go 8, 12, 8, 13, and 18. 8, 13, and 18. PE, 15, 18, and 21, which I think is just absurd. And with more risk, I'm going to put more desired return in there. So to me, I look at this going, yeah, this is obviously overpriced to me because for the company, 13% revenue growth for 20 years. So let's calculate that. Let's see how logical that is. 1.13 to the, 1.1. What's their current revenue? Mo?
Let's see.
87 billion? Oh, 75 billion?
75 billion.
That would take them to $864 billion. Okay, 20 years from now. Let's say the average car right now is $45,000, because for them to sell that many cars, they have to get their average price has to decrease. Let's say it goes up 3.5% a year for 20 years, times 45, 90,000. Let's say it's $100,000. $865 billion divided by 100,000. That's selling 8.7 million cars a year. Okay, not terrible, very reasonable, but profit margin and then PE. So can somebody make the argument for Tesla today? Sure. But to me, this factors in zero downside. It's a lot of positivity. And that very well could work out. But I just don't think that that's reasonable for Tesla. I think there's so many issues with Tesla's growing pains and with Elon Musk's all over the board.
I don't think it's reasonable for any company to just say, we're going to go with the best assumption.
And by the way, somebody might sit there and say that's not the best assumption. Look at Meet Kevin. He has a 70 PE.
Kathy would.
Look, put a 70 PE on this. Like Meet Kevin, the moron that he is. Analyze. And by the way, even Meet Kevin's ridiculous 70 PE. All right. 30%, 165. It's not insanely. And guess what? He was saying that when the stock was much higher than this. Was over that 165.
That's pretty much his peak.
So guys, start with 52-week lows, but don't forget the next step, which is what's the company worth? And then once you've determined that, you've got to figure out a way to emotionally take things aside and say, I'm going to buy it as it goes lower. If you like this, subscribe to the channel. If this is causing a little concern for you, don't worry. As long as it makes a little bit of sense, keep watching some of our videos. You'll walk away understanding money much better because the more you learn, the less you fear. Thank you.